Okay, so we will learn about stock. It says corporation accounting. But as we know from a financial accounting standpoint, well, a lot of the accounting we've been doing all semester is really in relation to corporations. We talked a little bit about partnerships. Next week is going to be completely on partnership accounting. We talked a little bit about sole proprietorships here and there, but really most of what we've been doing revolves around corporations. So in this chapter, really what we're focusing on is stocks. Because we've already covered bonds in our chapter on, which one was it? Long-term liabilities. And I think it was long-term liabilities. We talked about bonds. But we haven't really dug deeply into stock. So that's what we're going to do in this chapter. All right. Well, we know that one way companies can raise money is equity financing, which is just selling stock, right? You're increasing the equity of your company when you sell shares of stock to investors. We'll look about how to journalize those transactions when the stock is issued. And in some cases, companies buy their stock back from investors. That it actually used to be illegal. Today it's legal, but it's not something that happens all the time, because that would be a situation where a company has extra money, right? Because the whole point of stock is you get money from investors so you can grow. So why would you buy back the stock? Because then you have to pay the investors. You have to give them money, right? Why would you do that? Actually, why would you do that? Any thoughts?
So you could try to get a majority of the company.
Okay. You gain more control as you own more shares of stock. That's true. What else? Remember supply and demand from economics or intro to business? If you reduce the supply of stock that's available because you bought it back, there's less stock out there available on the market, it pushes up the price. So that's an easy way for companies, if they have extra money, to get their stock price up, is to buy back their own stock. And we'll look at how that actually works later in the chapter. Excuse me. We'll look at dividends when the companies pay out dividends to their investors. Now, that's usually in the form of cash, but sometimes companies will give property, maybe free products, to their investors. Now, I think most investors out there would rather have the cash, right? You buy stock in a company, Coca-Cola, for example, you don't really want them sending you cases of Coke. Maybe you don't even drink it. You just wanted to invest. So you'd rather have cash. But sometimes companies do that. They do pay dividends in property. And sometimes they pay dividends by giving the investors more stock. And that sounds like a good thing, but not necessarily. Because if you have more shares of stock, again, it upsets that supply and demand. So the stock you have might become worth less. So you've got more shares, but each one has a lower value. So it's not always in the best interest of investors, but we'll look at how those stock dividends work. And then we'll look at something called stock splits, where a company artificially changes the number of shares that they have outstanding and the value of those shares. We'll look at the equity that the stockholders have in the company. Now, equity represents the value of the company, right? But part of that is the stock that has been issued, where the investors own that portion of the company. But part of the value is really controlled by the company. It's the retained earnings, where the company has held on to some of the profits. They haven't paid dividends. They haven't reinvested it. They've just retained it. So we'll look at the relationship between those different aspects of equity. And then we'll look at a ratio, earnings per share. That is perhaps the most common ratio that investors look at when they're looking at the value of the stock. Definitely one of the most common. So this is going to be review. I'm sure you remember all this already. Corporations are separate legal bodies, right? They exist as a legal person under our laws. The stockholders can also be called shareholders. They are the ones who own shares of stock. They have invested in the company. The word incorporation is just the process of forming a corporation. So let's say you started a business and at some point you decided to make it a corporation. Who can authorize that? Who would you go to get approval to operate and exist as a corporation? It would be the state, or I should say a state. You could pick any of the 50 states, and each one has different laws on corporations. Some are more friendly to corporations. Some are more friendly to employees and consumers. So you could pick whatever of the 50 states in the United States you prefer and incorporate there and form your corporation. And you don't even have to have your business in that state. Kind of a weird thing, but that's the way it works. So, as I mentioned, the corporation is a separate legal entity. It has many rights that we enjoy as individuals in our country. It has the right to own property. It has the right to have employees, to sue and be sued, to have debt. All of these are rights of the corporation, right? So if you've got a group of investors that have put their money in and started this corporation, now this corporation is kind of its own separate person under the law. And if the corporation gets in trouble legally or financially, the investors are kind of shielded. Their personal assets are protected. And they cannot be held responsible for the actions of the corporation. That is called limited liability. So what is the most you could lose as an investor? You spend $100 on stock in some corporation. That corporation commits fraud, goes out of business, has a whole bunch of debt. Can anybody come after you for the debts of the corporation as an investor? They cannot. You're right. And they come after you for the actions, the fraud that the corporation committed. Can they come after you? No, they cannot. That's right. So what's the most you could lose as an investor in that corporation? Your investment. Exactly. Whatever you put in, you might never get that money. If somebody's willing to buy that stock from you, maybe you could sell it to them. But if the stock is considered worthless, nobody's going to want to buy it. So that is how our whole corporate system is set up, right? Corporations can raise money from investors, use that to grow the company, and the investors are shielded from any liability. Well, other than losing their investment. It's easy to transfer ownership in the company. One investor can sell their shares to another investor. Now, if it's a privately held company, there are limits on who can own the stock. What is it? The Koch Industries. I was trying to think. They're always the company I think of if I think of a privately held company. Koch Industries. Maybe a better example would be Twitter, because Twitter was publicly traded, and then when Elon Musk got involved, he took the company private. And I think it's still private. Does anybody know for sure? Can you buy Twitter on the stock exchange? I don't think so. So as a privately held company, the public cannot buy stock. It's not sold on a stock exchange. So you'd have to buy it directly from the company. And to do that, you have to be what's called an accredited investor. Roughly means you need to have about $1 million in assets and many years of investment experience to buy stock directly from a company. So, the average American is not going to qualify. But when a company is publicly traded, then their stock can be sold over a stock exchange. And then anybody that can buy stock on the stock exchange. Imagine you have to be at least 18 years old and have some money, but that's pretty much the only criteria. And then you can buy stock. So it's very easy to transfer ownership in publicly traded companies, corporations. Corporations are typically assumed that they're going to continue existing forever. So they're kind of immortal in that sense, because the ownership can just keep changing. If somebody doesn't want the stock anymore, they sell it to somebody else. If somebody passes on, their beneficiaries can inherit the stock. So the corporation just continues regardless of who happens to own the stock at that point in time. Unless, of course, it goes out of business or somehow merges or is acquired by another company. But otherwise, the corporation just continues on ad infinitum, as they say, forever. And it's very easy to, if you've got a profitable business, a profitable corporation, it's very easy to attract investors because they're looking for places to invest their money and get some dividends or possibly capital gains. So to create your corporation, like I said, you have to pick a state and incorporate through the state. You're probably going to want to work with an attorney. There are websites that will help you with this, so you don't have to go through an attorney. It could save you some money, but it's not going to be, you're not going to get the level of custom guidance that you would have with an attorney. So generally, it would be advisable to work with an attorney when you incorporate. If you're trying to promote your business, especially to other investors, you're going to have some costs associated with that. And then there are going to be filing fees that the state charges you. All of those costs for forming a corporation are the startup costs that you can journalize. We'll see an example of it when we get to the exercise set. So you are regulated by the state that you chose. And as a corporation, you're regulated by many other government entities as well, including many at the federal level. So there's a lot of regulation with business in general, but especially with corporations. There are taxes. Income taxes, property taxes, payroll taxes, sales taxes, on and on and on. Let's see. The shareholders themselves are going to have to pay tax on their dividends. Dividends are taxed at whatever is their, God bless you, whatever their income tax rate. So in other words, when they get dividends from their investments, it goes on their tax return, and whatever is the interest rate they're paying on their other income, they pay the same rate for their dividends. If an investor sells stock that they own and they made a profit, that's called a capital gain. That also gets taxed. It gets taxed at a different rate, which is typically lower than the dividends, but it does get taxed as well. That's when you sell the stock. So that means that the corporation paid tax on its profits, and then the investor paid tax on their dividends and any capital gains they made if they sold the stock. Any questions so far? Okay. So in deciding whether as a corporation you should raise money through debt or equity, Remember, debt would be borrowing money from a bank or some other lending institution or issuing bonds, right? Both of those would be debt. And then equity would be selling stock. So deciding which way to go, you have to consider, well, the more stock I sell, that dilutes ownership, right? It gives me, as the company or as the founder, less control. Even if you retain, let's say, 50% of the stock as the founder of the company, the other stockholders, if they get together and agree on something that you disagree with, you're now 50-50, right? So maintaining control of the company, well, you'd probably want to ideally keep at least 51% of the stock. But then that limits how much you can raise. So if you're more interested with raising more money, you might be willing to give up the majority ownership of the company and the control. But still, the more shares of stock you issue, that dilutes the ownership. Then when dividends get paid out, you're taking those dividends, whatever amount the board decided to pay out, spreading it across more and more owners, right? Also, the earnings per share I mentioned earlier, you're spreading those earnings across more shares of stock. So the more shares of stock you issue, it dilutes the ownership, taking away some of your control and reducing really the stock price. So instead, you might want to issue debt so that you don't have to give up that much ownership in the company. But obviously, you don't want to have too much debt either, right? Because then investors also won't want to invest in you because they'll say you have too much debt. That could also hurt your stock price. So to maximize your stock price, you really want a balance of debt and equity financing. If your company is so profitable, you don't need any debt and you don't need to issue stock, great. You can use your own profits to grow. But for most corporations, they find, even big corporations with billions of dollars, it still benefits them to have some debt and issue some equity. It actually tends to increase the stock price. Even though that might not seem logical, because it frees up more of their other cash for emergencies, or savings, or long-term plans that they might have. So most corporations do keep some balance between debt and equity. Debt, of course, has to be repaid. You have to pay back whatever you borrowed plus interest, right? That would be a negative to debt. That requires cash. It requires budgeting that into your whole plan, right? How much you can afford to pay and when. The cost of debt is the interest that you're going to have to pay primarily. What is the cost of equity, though? If you issue stock, again, your investors give you money, you give them shares of stock. Does that cost you anything other than just a little bit of bookkeeping? Not really. So when we talk about the cost of capital in terms of equity, what it refers to is how much it's going to cost the company to meet the investors' expectations. Because the investors are investing because they expect the company to make a profit, right? And to grow. So what's it going to cost the company to fulfill that expectation? How much is it going to have to put into the company to grow it? That is the cost of the equity. And then again, if you have too much debt, it reflects poorly on the company. So let's say you get into a situation where you have to go borrow some more money. Well, just like with us as individuals, if you have too much debt, banks aren't going to want to lend money, or they're going to charge you a really high interest rate if they do. Or they might require that you pledge some capital or some collateral to secure the loan. So, long story short, too much debt is a problem. Issuing too much equity is a problem. Issuing none at all is usually also a problem. So what corporations do is they use some debt and some equity, and that tends to have the greatest impact, the greatest optimization of their stock price. So if you borrow money as a company, you got the money, so your assets go up, and now you have a liability, right? But notice there's no impact on equity. The debt does not increase the equity portion of the balance sheet. Now, if you go out and you sell stock, let's see what impact that has. Well, you got money from selling stock, so your assets go up, and you issued stock, so your equity goes up. Notice there's no impact on debt, right? Okay. Any questions at this point? Okay, I did mention that some companies are publicly traded, some are private. As it says here, the SEC says that a publicly traded company has to disclose certain information regularly to the public because their stocks and bonds are traded on public markets, right? Securities are stocks and bonds. By the way, what does SEC even stand for? SEC. Securities Exchange Commission. They oversee the stock markets and the bond market and the corporations. Even though the FASB, Financial Accounting Standards Board, came up with GAAP and updates GAAP as necessary, the FASB does not have the power to enforce GAAP, but the SEC does. So if a company violates GAAP in how they prepare their financial statements, especially if that ends up deceiving investors or other parties, it's the SEC that can enforce it. They can impose fines. And in some cases, people can even be sentenced to jail for securities violations. The SEC gets involved with that too. Okay. That is a federal organization, by the way, the SEC. Okay, so let's say you wanted to take your company public. You started the company, you formed a corporation, but you want more money from investors. You really want to grow the company and you need money to do it, so you're going to go public. All right, well, here are the steps. You need to have a strong management team in your company. You have to have a reporting system in place. All this semester, we've been learning about how we create financial reports. So I think you're familiar with the importance of a reporting system. You would work with an investment bank. These are banks that deal with institutions and very wealthy people. They're not the kind of bank you tend to see around town. Does anybody know any examples of some investment banks? Goldman Sachs, Schwab, one of the biggest. Which one?
Is Schwab an investment bank?
I don't think so. So Schwab, they you can invest your money through Schwab. They're probably a broker dealer, investment advisor, something like that. But I don't think that they are technically an investment bank. So there's Goldman Sachs. There was Bear Stearns. They were one of the ones that got into big trouble back in 2008. They ended up getting taken over by Chase. Merrill Lynch is an investment bank. What else? Oh, there was also the Lehman Brothers, which is the one that collapsed back in 2008. These are examples of some of the investment banks out there. And so you pick one of them, one that's still in business, to work with you and help you take your company public. They would help you market to potential investors. And remember, as a corporation, even if you're publicly traded, the stock you sell is only to accredited investors. You're not going to be selling your stock to the average investor. So the investment bank's going to help you market to those institutions and other wealthy people that can buy your stock directly. You need to be able to convince those investors why you are a really good investment. If they don't buy your sales pitch, they're not going to invest, right? So we'll see this question comes up later when we get to the homework. Now, those initial investors that buy your stock, they're looking to make a profit. So they have to decide when to buy and when to sell, right? So let's say some investors buy the stock in your corporation directly from you. And at whatever point they decide it's time to sell. If you're trying to buy back the stock, they could sell it to you. They might be able to sell to other private investors. There might be that possibility. But they could also sell the stock on a stock exchange. So they bought it directly from the company, but now they're selling it over a stock exchange. And then any investor that can buy on the stock exchange could buy it. We call that the secondary market. So the primary market is when an investor buys directly from the corporation. Secondary market is when they buy stock over a stock exchange. Here's just an example of these days, so much of what happens is done on computers. In fact, sometimes it's algorithms buying and selling stock instead of stock brokers. But it used to be that you'd have a bunch of traders on the stock market floor buying and selling from each other. If you've ever seen old movies of this, and not necessarily that old, but like from the 80s, 90s even, you see them like yelling at each other, buy, sell, I want 3 shares or whatever. And there are all these different stocks. I mean, you see here, tons of different companies. Most of them you've probably never heard of, I've probably never heard of. But it says the bid and offer prices for that stock, what was the amount or the price of the last share, and the volume of how many shares have been traded. So we've kind of commodified this whole idea of stock, right? People don't think of it so much as I own part of this company. They think of it as I bought this and I'm hoping it goes up in value. So it's almost like gambling. I guess the difference is gambling is often illegal. It's only legal in certain contexts. Buying stock is legal, right? There's really not a whole lot of difference because you can research a stock, a company, an industry, but you still don't know really for sure if the price is going to go up or go down, right? You're always taking somewhat of a risk. So in that way, it's kind of like playing poker at a casino. You know, you might win, you might lose. And there are cheaters in both cases, in casinos and in the stock market. Okay, so let's get into actual types of stock. So I said earlier that you have to go to a state in order to get incorporated, right? And be a corporation. And then it's the state who can authorize you to issue shares of stock. So you might say to the state, I want to be able to sell, 1,000,000 shares of common stock and 100,000 shares of preferred stock. And the state then can give you that authorization. But just because you have the authorization doesn't mean you sold the stock. So we'll see that there's some important terms we'll get to, not on this slide, on a different slide, about different phases of a stock, from being authorized to being bought back by the company. There can be a specified number of shares for each class. So like I said, there's common stock and there's preferred stock, and we'll discuss the difference in more detail. But also you've got different share classes. And this kind of depends on the company. It can vary, but generally A-class shares would be better for an investor who's planning to buy the stock and hold it for a long period of time. B shares give you less voting rights and less preemption rights, which means that if the company, let me explain what a preemption right is. If the company is going to issue more stock, let's say you owned 2% of the stock, and you have that preemption right. When the company issues more stock, you would be eligible to buy enough of that stock so that you maintain your 2% portion. That's what a preemptive right is. You can buy the stock ahead of other people so that you can maintain the same ratio or proportion of stock. Kind of like when you, if you get priority registration, it lets you register sooner for your classes. Same idea here. You get to buy the stock before other investors so that you can maintain your same proportion. But you have less of that if you buy B shares. And if you buy C shares, those are really better if you're not planning to hold the stock for a long time. You will pay a lower fee, lower sales charge and expense ratio if you're going to hold the stock short term compared to with the A shares. Okay, so that's useful to know if you're ever thinking of buying stock and you've got the option A shares, B shares, or C shares. It makes a difference, and it really depends on what are your plans for how long you're planning to hold the stock, and do you care about voting rights or not. So common stockholders in general do have the right to vote. They might get dividends if dividends are issued, but they might not. It just depends. Because the preferred stockholders get dividends first. So in some cases, there's nothing left over for the common stockholders. If the corporation goes out of business, sometimes that happens, right? Company gets into trouble, they can't pay their debts, and so they go out of business. They have to pay back customers that they owe money to. They have to pay back suppliers. They have to pay any taxes that are due. All of that has to be paid for. They have to pay back any lenders and bondholders. And then only if there's any money that's left over, do stockholders get anything. And even among that leftover money, it would go first to the preferred stockholders and then to the common stockholders. So if you own stock in a company that goes out of business, there's a really good chance you won't get that money back, or any money back. And that's part of the risk you take as one of the owners. So I already talked about preemptive rights. So that's pretty much it here for this slide. Any questions out there? All right, preferred stock. Why is it preferred? Well, not because of voting rights, because preferred stockholders do not get a vote. So when it's time to elect a board of directors, or if there's something that was put before the stockholders to vote on, the preferred stockholders do not get to vote. The reason it's preferred is when dividends are declared, the preferred stockholders get them first. That doesn't necessarily mean that they get more dividends, but they get them first. So, as I said, there might be some cases where common stockholders don't get any dividends, but the preferred stockholders do. Okay. So here we're going to get into the terminology. This is really important for this chapter to understand these terms. So the state authorizes how many shares of stock can be issued, right? When shares of stock are actually sold, then they're called issued. So issued means sold. Okay. The shares that have been issued but have not been bought back by the company are called outstanding. And then the ones that are repurchased by the company are called treasury stock. So I think we have a graphic here that explains it very clearly. So these are really the 4 different phases of stock. It's authorized by the state. Once it's sold, it's issued. And the amount that is outstanding is what has been issued minus whatever has been bought back by the corporation, right? So here the outstanding stock is 1,400 shares because 1,500, well, out of the 1,500 shares that were issued, 100 were bought back by the corporation. Now, why does this matter? Does anybody know why it matters? Why do we need to know how many shares are outstanding? Well, one reason would be dividends. When dividends are paid, they're only paid on the outstanding shares. They're not paid on the treasury shares. And they're not paid on any unissued shares. Why would treasury shares not get dividends? Who owns the treasury shares? Company. Who pays the dividends? Also the company, right? So it would just be paying dividends to itself. Right? Pretty pointless. So when dividends are paid out, they're only paid on the outstanding shares. And that's why we have to understand the distinction between the two. Another reason that we need to know the outstanding shares is when we calculate earnings per share, we take the earnings of the company and divide them by the outstanding shares of common stock. There's one more step in that formula, but we'll get to the formula later. Okay, so again, in this case, the state authorized 2,000 shares. So far, only 1,500 have been issued. So we have 500 that have not been sold. They're still authorized, but they just have not been sold yet. And then out of those 1,500, only 1,400 are outstanding. Okay. Stock values. All right. Well, the market value is what people are willing to pay for the stock. If you remember, in fact, I'll just go back to it. This image here, it shows the bid and offer price. So that's here you've got somebody is willing to pay 10.5 cents for this stock, and somebody's trying to sell it for 11. And only when the bid and the offer meet is there a sale. So we see the last share of the stock was sold at 11 cents. And we see the volume, how many shares of that stock were sold. Okay, now where was I? So the market value is how much somebody is willing to pay for that stock right now. So how is that determined? If you look on a stock exchange, you pull up any stock and see what it's selling for, who determines that price? The investors, right? The ones that put in a request to buy the stock, they specify what price they're willing to pay. And if there's an investor that's willing to sell at that price, bingo, there's a deal. And the stock changes hands. So even though corporations want their stock price to go up, they don't really control the stock price. They can influence it, right? Like I said, they could buy back their own shares. They could try to find the right balance between debt and equity. All of this helps to kind of push up the price to some degree, but ultimately it's up to the investors. Like the whole GameStop thing, right? If you are aware of that situation, there were a lot of powerful hedge fund managers out there that thought GameStop was a failing company. And so they were betting, because you can, in a sense, you can take bets in the stock market. They were doing technically what's called short selling, but they were betting against GameStop. And what they were assuming would happen was the value of GameStop stock would go down, and these hedge fund managers would make a lot of money because the stock price went down. So there is a way to make money on a stock losing value. But then a bunch of people on Reddit said, we don't like that. We want to make GameStop's price of its stock go up. And all these hedge fund managers are going to lose a lot of money. And they did it. These investors on Reddit, they got together, they said, hey, let's all buy GameStop. And it wasn't necessarily that they thought that they were going to make money on it. It was more, I think it was more, they just wanted to troll the hedge fund managers. Maybe there were some that did want to make money on it. But they were successful because they got enough people to buy the stock. That did cause, the price to go up, and it caused the supply of the stock to be less because they bought the shares that were available, and that pushes up the price. Which then causes other people to say, oh, look, the stock price is going up. I better buy some. And then that pushes up the price even more. That's why we get these bubbles. So they were winning. They outsmarted the hedge fund managers until the hedge fund managers convinced the underlying platform that managed the trades to put a halt and not allow any more trades of GameStop. I'm not even sure that that was a legal move, but it allowed the hedge fund managers to not lose as much money and caused the GameStop purchasers, the Reddit folks, to lose their money.
There's a whole movie about it, so
There is, yeah, there's a documentary about it. I forgot. Do you remember what it was called?
it's all pretty movie.
Yeah, yeah. But the reason I share it with you is just to illustrate that stock price is up to the investors. There is psychology that goes into it. There's strategy. There is sometimes analysis, misinformation. Companies do not control the stock price. However, they can influence it, right? They can put out their financial statements and show how profitable they were. They can buy back their own stock. There are some things that they can do to influence it. And interestingly, the market value, what the stock is selling for, does not appear in the accounting records. That stock price changes not only every day that the stock market is open, it changes throughout the day. So from an accounting standpoint, we don't pay any attention to the market price. There are a few cases where we do, but in general, when we're creating the financial statements, we do not pay any attention to the market price. What we pay attention to is what's usually called a par value. That is a fictitious amount, arbitrary, just an arbitrary amount that the company came up with. And they said, this is going to be the value of the stock on our books. And it stays the same, typically. So that par value, like it says, is also called the face value. In some cases, it might be called a stated value. But it's the same thing. It's just an arbitrary amount that we use for bookkeeping purposes. It might be as small as a penny, might be, I think we see some examples where it's up to $100, but that's it. Something in that range. As it says, in some states, and remember, state law regarding corporations varies in every state. In some states, the par value is the minimum price at which the stock can be sold. But that's only in some states. So here we see an example. This is from a stockholder's equity statement for some company. And it says, let's see, preferred stock has a 1 cent par value. It shows how many shares have been authorized, but then it also shows how many shares have been sold. So only 19,250 shares have actually been issued or sold. So if you take the number of shares that have been issued, multiply it by the par value, that is what it shows here as the value of that stock in the company's books. And again, it has nothing to do with the market price. However, when a company does sell stock, they might receive more money than the par value. Hopefully, they're selling the stock for more than a penny a share. So when they sell it, anything that they receive above the par value, oh, we don't see it here. Okay, is here. Additional paid-in capital. So that's going to be an important account for us this week. In this example, the company sold 8,000 shares of common stock, and they sold it for $21.50 per share. So that brought in $172,000 of cash. And we take the 8,000 shares, and the par value is $1.50 per share for this company. So $1.50 par value times the 8,000 shares that they sold, they list that as $12,000 of common stock. All the rest of the money that they received, they list here as additional paid-in capital. In other words, the cash that they received minus the par value is the additional paid-in capital. Okay? Any questions about that? All right. Now, usually when a company issues stock, it's because it got money from the investor. There could be cases, though, where the company issues stock in exchange for property, or like it says, services. So especially if you're a startup company, maybe you don't have a lot of cash and you need help from a lawyer. So you say, hey, instead of us paying you, could we give you stock in the company? And if they agree to it, great. They provide their legal services, you provide them with stock. So here's an example of that. Here, let's see, there were $8,000 of legal services. Okay, so that's what the company received, and now they have the legal services expense of that $8,000. And they issued 2,000 shares of common stock. All right, well, that common stock had a par value of $1.50 per share. So you take the number of shares that they gave to the lawyer, multiply by the par value, and that is credited to common stock. Okay, that is stock the company has issued. The difference is additional paid-in capital from common stock. So in other words, what else did we get that exceeded the par value of the stock? All right, so now, oh, this was, what is this? Oh, that's right, that's right. Okay, so in this example here, where they issued stock for cash, they issued $12,000 worth of common stock, right? That was the par value. And then here, where they issued stock in exchange for the legal services, they issued $3,000 worth of common stock. So combined, they've issued 15,000 shares altogether. And they have $165,000 of additional paid-in capital. Again, that's this additional paid-in capital plus this additional paid-in capital. Okay. So this is something new for us. We've not had to do this before, but when stock is issued, this is what you do. All right. What if there is no par? There are cases where states don't require that there be a par value, but there might be a stated value identified by the company. You treat that just like par value. Okay, so two different terms, par value, stated value, but we treat them the same. So there's nothing really different you have to do. What if there is a state where there's no par value and the company does not declare any stated value? Well, then it's pretty simple. You sell $172,000 worth of stock, you just record it as $172,000 of stock. There's no additional paid-in capital in that case. Okay. So preferred stock. Preferred stock works really the same way. The only difference with preferred stock is when we're calculating dividends. Because remember, preferred stock gets dividends first. But here, 1,000 shares have been issued at a par value of $45. No, I'm sorry, sold at 45 at a par value of $8. Okay. So 1,000 shares sold for $45 each, that's $45,000 that the company receives. So we see a debit to cash in that amount. The par value of $8 times the 1,000 shares gives us an $8,000 credit to preferred stock. And the difference, again, is just additional paid-in capital. Now, one thing you might notice here, there's a percentage here for preferred stock. What that percentage refers to is when dividends are declared, how much of those dividends do the preferred stockholders have a right to? They have a right to whatever the percentage is times the par value. Okay, so when we get to dividends, we will use that percentage. But with common stock, there is no percentage because they get the leftovers. Okay, so now the same company at this point, remember that we saw that they had issued 15,000 shares of common stock. Now they've also issued some preferred stock. We see there's additional paid-in capital from the preferred stock. That was this line here. So that is what their statement of stockholders' equity looks like so far. All right. Any questions? The treasury stock is when the company buys back stock from its investors. This, as I mentioned, used to be illegal, now it's legal. I might have mentioned this before, I don't know, but during the Trump administration, there was a really big tax cut for corporations and wealthy people. And since corporations don't have to pay as much in income tax anymore, they have a lot more cash. So what have they been doing with that cash? Now, the argument was, if they have more cash, they'll hire more people and they'll expand their companies. And to some degree, they have. But another thing they've done with their extra cash is buy back their stock. Because like I mentioned, when a company does that, it reduces the supply of stock and it pushes up the stock price. And then the executives that are running the company and are compensated primarily in stock become very wealthy. And if you look at our stock market, I've probably shown you all the S&P 500 and how it's changed over time. Have I shown that in this class? Okay, let's take a look. So the S&P 500, if you don't know, is an index of 500 corporations that give us an idea of what the overall stock market looks like in the United States. So if I pull up the S&P 500 index, this just shows today. So you can see that the value of the combined stock of these 500 corporations has been going up and down throughout the day as investors buy and sell. But if I go back to a much longer period of time, so I go back to early 1980s, when I was still getting my undergrad, way back in the day. You see the S&P 500 here fairly flat, right? It was generally going up, but it would stay fairly steady. So again, this is the combined prices of 500 corporations. And then you see they start to go up pretty significantly. And then they came down just as fast. Does anybody know what this bubble was here? This would have been late 90s and peaking somewhere around 2000, 2001. This was the dot-com bubble or tech bubble because the internet was really just becoming a thing in the late 90s. And a lot of companies were creating internet-based companies. So there was a lot of speculation by investors that they'd make a lot of money if they just invested in these internet companies. And some did, but some didn't. So once it became apparent that a lot of these new internet companies really didn't know what they were doing, didn't have profitable business models, investors started to pull back. And there was this contagion effect where some investors start to get scared, so they sell their shares. That could make other investors scared, and they start to sell their shares, and it just snowballs. And you end up with this bubble bursting. So a lot of investors at that time said, well, we don't think the stock market is such a great place to invest right now. What should we do with our money? And a lot of them put their money into real estate. And so the real estate housing market really started to take off. And then people on Wall Street came up with ways that you could invest in real estate through Wall Street. So you could buy real estate investment trusts and mortgage-backed securities and collateralized debt obligations, all these fancy new types of investments that were tied to the housing market. Well, you can see the stock market recovered. However, when it started to be clear that the housing market was now crashing around 2005, 2006, investors started to get out of housing, which caused housing prices to go down, which meant a lot of people who'd bought homes they couldn't afford were now stuck. And as their interest rates started to go up and they could no longer afford their mortgages because interest rates went up at that time, that's a Federal Reserve thing that I think you're aware of, that they control interest rates. A lot of people were losing their houses. So that caused further pressure on the housing market. And it also caused problems here on Wall Street with all these mortgage-backed investments. So Wall Street started to struggle around 2008. Started in early 2008, that's when Bear Stearns, one of the investment banks I mentioned, ran out of money. They had taken such big risks with investments that were housing related, they ran out of money. And the federal government got involved. They convinced Chase to come and bail out Bear Stearns, to actually buy Bear Stearns. But then later that year, this was getting close to September, October of 2008, another large investment bank that had been around for a century was having the same problem. They'd invested too much money into risky investments. Things were not working out. They were short on cash. They were about to go out of business. And the federal government took a look at it, tried to find somebody to buy Lehman Brothers to keep them from going out of business, couldn't find a buyer. And Lehman Brothers failed. And initially, investors looked at that and they said, well, they kind of deserved it. And the stock markets were okay. Which the federal government had been really worried that the stock markets were going to freak out. But then the problem wasn't over, because it wasn't just Lehman Brothers. There were many banks, many financial institutions, even companies like GE, General Electric, which you would think would have nothing to do with banking. Well, they had a major division, a finance division, and even they were in trouble. So you have all these financial institutions. Some were okay. There were some that had been smart and did not take risky investments. But there were too many that did. And so this is late 2008, the federal government said, this is bad. We're about to see the meltdown of our entire economic system. And so they had to do some pretty radical things. They had to force banks to take money. Even the banks, the president called the CEOs of the major banks in and said, you're all going to take money. And the ones that were fine, that didn't have a problem, said, we don't want your money. And the answer was no, you have to take it, because we have to let investors know that you're secure. We have to be able to tell them we gave money to all the banks are not going to collapse. That's how scary it was. And so they did that. There were other programs. Well, of the three major auto companies in the United States, two of them, GM and Chrysler, were about to go bankrupt. Ford was okay. Ford had had some financial difficulties previously, worked itself out of it, and they were in a good financial situation. But GM and Chrysler had to get bailed out by the federal government, otherwise they would not exist anymore. So anyways, long story short, through some pretty wise decisions on the part of the Federal Reserve, the federal government, we avoided a major collapse of our economy, and we avoided a depression. however, was still pretty bad. We still saw the stock market here. Look at this. See how quickly it fell right here? October 2008. It's like, watch that little circle, right? It goes going along, it's going along, it's kind of rocky, and then boom. Just, and people saw that, you know, their retirement nest eggs had lost half of their value. So now their home had lost its value. Their retirement had lost its value. A lot of people were getting laid off. It was really ugly. But it wasn't a complete disaster. So within, I don't know, a year, you know, the stock market started to recover, and you see it here. And really within a few years, let's see, now we're getting, by about 2013, we reached the same peak we had been at the dot-com bubble and the housing Wall Street bubble. We got back up to that same point. So you would think that was another bubble and that we'd see things go down. Well, what's happened since? Stock market kept going up and up and up. So Trump comes into office 2017, and the tax cuts were, I think, about a year later, 2018. So we see a little bit of rockiness here, but overall, the stock market's just continued to go up and up. Now, we did have a major drop here due to COVID, right? Initially, investors were really panicked, but quickly the stock market recovered. Then we've had some other bounces due to oil prices and tariffs with China and things like that. But we have been a record territory, even just recently. I mean, look, that's the highest the S&P has ever been this year. So those repurchases of stock by corporations really started to happen after they got their tax cuts in 2018. I guess that a lot of this continued growth in the stock market is really primarily because corporations bought back their own stock, and that pushed up the price. So to me, this seems fairly artificial and unsustainable. Now, I was saying that 7 years ago, and it's continued to go up. So I'm not telling you to go buy or sell stock. I have no idea. I have no idea what the stock market's going to do. I mean, the housing market it's at a peak too, or it's, you know, it's come down a little bit, but it's pretty much near a peak. I have no idea what they're going to do, but they seem unsustainable to me. So I think we will likely see at some point a major downturn in the economy, or at least in the stock market and housing market, but that's probably going to impact the overall economy as well. We might be seeing oil prices go up this year because certain other countries would like to see Biden out of power. And they know if they can raise oil prices, that's going to make Biden look bad, even though it's not anything he can control. So if that happens, if we do see oil prices start to go up and the cost of gas and electricity and everything go up as a result, not only does that have political consequences, that could significantly hurt the economy. That could be something that tips us into the next recession or maybe even depression. Let's hope not. Now, recessions are very common. Historically, we have a recession, which hopefully you remember is when the gross domestic product declines for at least 2 quarters in a row. So in other words, if we make less stuff in America for 2-3 month periods in a row, that causes a recession. We have not had one of those since 2009, since back here. And historically, they've happened about every 7 years. So we're way overdue for a recession. What does that mean for the future? I don't know. But again, I think that companies buying back their own stock is a big part of why the stock market is so high. And it has been, I'd say, for the last 5 or 6 years. That's my guess as a non-economist. Okay, so when a company does that, buys back their own stock, we call it treasury stock because it's part of the corporation, right? The corporation has the stock in its own treasury. Did I just mess something up here? Before it was an issue. So let me just check my audio. I think it's okay. Okay, so when a company buys back its own stock, it's then called treasury stock. And like I mentioned earlier, no dividends are paid on treasury stock. So that's what we see here. The company bought 800 shares of its own stock from an investor who was willing to sell it. They paid $25 per share. So 800 times 25, I guess is $20,000. Sorry, yeah, that's right. And this is how we would journalize it. It would be a debit to treasury stock and a credit to cash. So when we issue stock, common stock, for example, we credit common stock. But when we buy it back, we use a different account. We use treasury stock. That way we can keep track of which stock we own and which stock is owned by investors. Now, if we go back to the stockholders' equity section, you see all those shares that we had issued previously and the additional paid in capital. And we see here the company's retained earnings is listed there as well. God bless you. But notice the treasury stock down here at the bottom is negative. Because the treasury stock, again, is not owned by the investors. So we subtract it to get the total stockholders' equity. Okay? Because what does it represent? It's stock we took back, right? And we're just keeping it. So it reduces the equity in the company. Any questions or comments? All right. Now, let's say we decide to sell some of that treasury stock, because companies can do that as well. When we sell it, if we sell it at the exact same price per share that we paid for it, then the journal entry will look like this. We got cash and we gave out treasury stock. Now, to the investor, it's just stock, right? But in our books, it's treasury stock. But what if we sold it for more than we paid for it? Okay, so this is how we would journalize that. In this case, we sold it for $28 per share and there were 100 shares. So we made $2,800, right? So it's a debit to cash. But remember, we only paid $25 per share for the treasury stock. So we take the 100 shares that we just sold times the original price we paid for it, $25, and we credit treasury stock, but that does not equal the $2,800 we received. So the difference is additional paid in capital. Okay? So you just have to remember, that's how you do it. With treasury stock, it's easy to journalize when you purchase it. It's whatever you paid for it. Debit to treasury stock, credit to cash. Nice and simple. But if you sell it at a different amount than what you paid for it, if you sold it for more than you paid for it, then you're gonna have a credit to additional paid-in capital. If you sold it for less than you paid for that treasury stock, then you have a debit to additional paid-in capital. Because our debits and credits always have to equal, right? So in this case, if we only got $2,300, but we paid $2,500 for that treasury stock, well, the difference between what we got when we sold it and what we originally paid for it is a debit. Okay. All right, an exercise. So we are going to practice journalizing here. Exercise 6, I'll give you a few minutes to work on this. What we have is the original purchase. Actually, I'm sorry, sale, because from the company's point of view, we are selling the shares of stock, right? So the original sale of the stock, what would we debit and credit? Then we have another sale of stock, but in this case, it's not for cash. We received a building in exchange for the stock. So what are we going to debit and credit here? And then we bought back some shares as treasury stock. Okay, so good luck. Feel free to work together on this. I'll check back with you in 5 minutes or so and see what you came up with. Okay, let's take a close look here. I'll zoom in to make it a little easier to see, but the questions are, at what price was each share of treasury stock purchased? What's reflected in additional paid-in capital? And why is there a difference between common stock shares issued and outstanding? Okay, so price of the treasury stock, start there. So what was the price per share for the treasury stock? How can we figure that out? We see the total of the treasury stock is $240,000, right? How can we figure out the price per share?
Go back to where your 40,000, 20,000.
Yep, divide by the 20,000 shares, which comes out to $12, right? Per share. Okay. I forgot already what the second question was. What is reflected in additional paid-in capital? Okay. So here we see additional paid-in capital. Where is this number coming from? What does it represent? Let's start with, do you think it has something to do with the preferred stock or something to do with the common stock? Common stock, yeah, because it's listed underneath the common stock. Okay. And so the common stock was 1.2 million, additional paid-in capital was 16.8 million. So where does that additional paid-in capital come from? So basically, it's just the extra money we received when we sold the stock that was above the par value, right? Because whatever you see here for common stock, $1 par value, that's that. We've sold 1.2 million shares at $1 each. So this additional paid in capital is extra money above the par value that we received for selling common stock. Apparently, we did not receive any additional paid in capital from selling preferred stock. And actually, that kind of makes sense if we're selling it at $100 per share. A lot of investors aren't going to want to pay more than that. So we probably got only $100 per share. Now, the last question is, why is there a difference between the shares of common stock that were issued and the shares that are still outstanding? What explains that difference?
The treasury stock?
Okay, great. 3 people said it at the same time. Yes, exactly. It's a difference of 20,000 shares, right? Between 1,180,000 and 1.2 million. And that is the 20,000 shares of treasury stock, right? Because once we buy back treasury stock, it's no longer outstanding. It's still been issued, but it's just not outstanding. So that's exactly right. Great. All right, let's see what's next here. Oh, guess I didn't need to go over there. Okay. Dividends. So, as it says here, some companies choose not to pay dividends and instead they reinvest all their earnings back into the company. When you have a company that's growing really quickly, they might just use that profit from their growth to fuel more growth. Amazon, for many years, not only did they not pay dividends, they didn't even make a profit because they kept taking what would have been profits and spending it on more and more expansion, building out their infrastructure, hiring more people. So when companies are growing really quickly, they might not pay dividends. And investors know that. In fact, investors look for stocks that pay dividends if that's what they're after. If instead they really don't care about dividends, if they'd rather just buy a stock that they think is really going to take off and see its value appreciate and then be able to be sold at a much higher price, then they might buy a stock that doesn't pay dividends and is growing more quickly. So investors know that. Here's a company though, Johnson Controls. As far as I know, they're still in business. They've been paying dividends consistently since 1887. So every 3 months when their board of directors meets, says, should we pay out dividends? Every 3 months since 1887, they have said yes. So if you are looking for a company that's probably going to pay you dividends, a company like that would be a pretty safe bet. But they are regularly spending all this money on dividends for their investors. That's less money they can use to expand the company, right? Okay, let me see how we're doing on time. We have like 1 minute. So let me quickly review when the board of directors decides to pay out dividends. There are 3 important dates. The first date is the date that they declare that they're going to pay dividends. It actually gets journalized, and we'll learn how to do that later. Then there's the date of record. On that date, if you own stock on that date, then you qualify for dividends, assuming there's enough to go around. If you don't own the stock on that date, if you already sold it to somebody else, you will not qualify for dividends. And then there's a third date, the date when they actually pay the dividends. So if you sell the stock, you might want to do it after the date of record, because then you'll still get the payment when it's made. Okay, so that's all we have time for. Come back in 10 minutes and we'll get started on the exercises.